All right, now we're talking about the Capital Projects Fund. The Capital Projects Fund was set up to build, buy, or lease significant fixed assets that are used by the governmental funds, not the proprietary fiduciary funds. So remember, we're not constructing an airport, we're not constructing utilities, those are business type, which those are all dealt with within the business type funds. This is for construction of governmental buildings. So courthouse, city university. And yes, I know you might be telling me, but Nick, you charge people to go to the theater or the university. We're not getting into that level of detail in this exam, so don't worry about it too much. Capital project funds have a short life and are limited to their construction periods, usually 1 to 3 years, although I've seen how long it takes some governments to build something, so I'm questioning that. All right, for the purposes of the test, this is what you got to know. All right, more revenues for the Capital Projects Fund. Just like in corporate accounting, capital projects are usually financed through bond proceeds or debt, as I mentioned before. The project may also be funded by a transfer from another fund, so essentially borrowing from another fund, also specific tax revenues or capital grants. What about investment earnings? Sometimes, well, when you borrow money, you might not use it all right away. And if you don't use it all right away, you'll invest it. You'll put it maybe in a high interest savings account. You'll put it somewhere where it can earn interest or dividends or anything like that. This is where we're going to record our investment earnings in the Capital Projects Fund and tax revenue. So tax revenue allocated for construction would be tax revenue of Capital Projects Fund and recorded like the general fund. So investment earnings may appear in the fund, but any disposition of those earnings, so getting rid of those earnings, may be to retain them in the fund for the benefit of the project, or immediately transfer them to a debt service fund for the benefit of the bondholders. So that's to repay the bondholders. Capital grants. Now, this is a government or some entity just saying, okay, we're going to give you some money to construct, to do something with. So capital grants, possibly from another governmental entity, received in advance of usage, are often recorded as a liability and displayed as earned as they are expended. So just like in non-for-profit accounting, right? Oh, wouldn't you know it? I said similar to non-for-profit accounting. Same thing, just like contribution revenue. And government grants may be restricted and are reported as revenue when earned. Same as non-for-profit when you start to recognize revenue from contributions. So they earn them when grant money is used up to pay for the building, or may be unrestricted or recognized immediately. Let's see the journal entries here. So the journal entry to record unrestricted government grant. So if there's no restrictions, then we are just going to immediately recognize it as cash and revenue, just like a sale in corporate accounting. What about journal entry to record restricted government grants? Well, this is going to be revenue when it's spent on the actual purpose. In this case, we'll debit cash and credit revenue collected in advance. Also known as accrual basis, also known as deferred service, right? Same concept there. What about journal entries to recognize revenue restricted when spent by a cost reimbursement contract? So this is basically now you're actually using that money and you want to recognize it. So right here, we're reversing out the revenue collected in advance, right? Revenue collected in advance. This is unearned. So unearned service revenue. All right. So first, we've got expenditure, expenses, and vouchers payable or cash. So this is when you actually spend it, right? Just like if you are spending money to buy inventory or on construction, you're going to debit an expense to increase it. You're going to credit a liability, maybe because you don't use the cash, or you're going to credit cash because you used cash. And then after that, you're going to get rid of the liability of unearned revenue, and you're going to credit to increase the revenue account. Awesome. Awesome, awesome. Now, what about general fund, interfund transfers? So interfund transfers, this is going to be when you move money between those different funds, and it happens a lot, right? So the journal entry to record a general or special revenue fund interfund transfer, we're going to debit cash, or due from other fund, because maybe you haven't gotten it yet. So it could be due from other fund, which is like a receivable. And you're going to credit interfund transfers, kind of like a liability right there. All right. Well, now we have a little bit more in depth. Johnson City issued a bond for $4 million in order to build a new outdoor theater. The bond was issued for a little bit more than $4 million, maybe a lot, $4,160,000. Assume that the government has been directed to use the premium for the protection of the bondholders. And if you're asking why this is higher than that 4 million, well, I advised you to go visit our bond section, looking more into discounts and premiums. This is the journal entry to record the bond proceeds in the capital projects fund. So just like in bonds, this is a bond journal entry, no different other than you see the wording's a little bit different, but in a sim or something like that, I wouldn't worry too much. They will be pretty recognizable as to what you'll have to put.